Welcome back to the deep dive. If you've been keeping an eye on financial news, well, you know things feel pretty turbulent right now.
Uh,
Our goal today is really to dive into that complexity. We've got a stack of sources, and we're focusing on where, public interest, market realities, and corporate strategies all kind of collide.
it is a fascinating tension, isn't it? Because finance, at its core, is about risk and return. Simple enough.
Right.
But then you have licensed banks, and they carry this public responsibility.
Mm-hmm.
And that conflict really came into focus with the president's recent comments, didn't it? Critiquing those super high interest rates for borrowers with lower credit scores.
Yeah, it forced a conversation.
Exactly. It makes everyone question that old principle, high risk, high return. I mean, where's the line? When does a bank's duty to shareholders, override its duty to the public it serves?
That's really the heart of it, isn't it? So we're going to start by looking at some policy ideas for tackling what our source are calling this severe interest rate fault line. Then we'll shift to the sort of physical side of finance. Who's actually left providing services when the big banks pack up and leave?
A really crucial question these days.
And finally, we'll contrast two really different corporate playbooks. K-Bank's like explosive digital growth, and then Hyundai Marine's much quieter, maybe even painful restructuring path.
Right. Two very different stories. So let's define that fault line first.
Okay, let's do it. This interest rate fault line, it basically describes how borrowing costs have become so polarized it just depends where you get your credit.
And the numbers are pretty stark.
They really are. They show exactly why this is a policy headache. So if you borrow from a traditional deposit bank, your average household loan rate is what, around 4.17%?
Yeah, something like that.
Manageable for many. But if you get pushed into that second tier, the savings banks, suddenly that rate jumps to 12.46%.
Wow.
That's 3 times higher.
3 times. And it's not just that it's higher, which is bad enough. The critical thing, I think, is the gap. There's just nothing in between.
Right. It's not a smooth curve.
No. It's like if you're considered just a bit too risky for that 4% loan, you don't just nudge up to, say, 6% or 8%. You fall off a cliff straight into that 12% plus zone.
And we see that really clearly with things like card loans for low credit borrowers. The rates there can leap from maybe 10% right up to 17%, even 19%.
It's a chasm, like you said, a financial chasm.
Yeah.
So the low credit borrower gets hit hard, not just because of normal risk pricing, but because the structure itself forces them into the most expensive bracket almost immediately if they can't access the cheapest one.
So fixing that missing middle,
Yeah.
what are the ideas? The sources talk about 2 main solutions. First one is about changing the credit evaluation system itself.
Getting away from just relying on that single credit score.
That's steep.
Exactly. That single score, it's convenient, right, for quick automated decisions. But does it really capture the whole picture of risk?
Probably not.
Well, look at the Japanese model. It's an interesting contrast. They tend to downplay the single score.
Oh, what do they use instead?
They focus much more on actual, verifiable financial records. Things like, has this person actually been delinquent? How much debt do they currently have? Is there bankruptcy history? Hard facts.
Okay, so focusing on the record, not just the score, what's the benefit there?
It allows for nuance, for differentiation. The single score just lumps everything together.
Right.
But looking at the records, a lender could maybe see, okay, this was a short-term problem, maybe medical bill, versus, someone with ongoing serious debt issues. That nuance is crucial for borrowers on the edge.
Which explains why experts are pushing for other methods too, like alternative credit assessment, using new tech, new data, and things like microfinance models.
Absolutely. Building a more complete picture. But that's just the evaluation side. We also need to talk about the banks themselves.
Right.
Which brings us to the second solution, the need for government fiscal support.
Okay.
Because banks, they have rules they have to follow. Capital requirements, risk management. It's strict.
They have to protect themselves.
They do. So if a bank starts lending more to higher risk folks at artificially low rates, their own financial health, their solvency, is immediately at risk. They'd likely have to pull back, restrict lending fast.
So you can't just mandate lower rates without addressing that risk. It puts the ball in the government's court, really.
Precisely. You're fighting market physics otherwise. Yeah. The sources seem pretty clear on this. If the real goal is to get more mid to low interest loans out there, to genuinely help vulnerable people access credit.
And the government has to step up.
Yes. With things like direct financial subsidies to cover potential losses and crucially expanding loan guarantees significantly, Without the government acting as a buffer for that extra risk, the supply of affordable loans just won't grow, no matter how much you criticize the rates.
Okay, that makes sense. And it links directly to our next point, moving from policy to, well, the physical reality, the geography of finance.
Yeah, while we're talking digital solutions, the actual bank branches are disappearing.
Which has real consequences for people.
Yeah, it really does. This commercial exodus is speeding up. The big names, KB, Shinhan, Hana, Wuri, they're cutting back branches aggressively.
Why? Just cost?
Mostly, yeah. It's purely economic. Running a branch can cost like up to $3 million a year. And in areas with fewer people, they just don't make money.
So they close them.
Exactly. The numbers are stark. Look at KB Bank. They went from 829 branches down to 621 in just 2 years, 2021 to 2023.
Wow, that's a huge drop. And the impact, I guess, falls hardest on people who maybe aren't comfortable with online banking or can't use it, especially in those depopulated areas the sources mentioned.
The stats there are pretty damning. Out of 84 areas officially called depopulated, nearly 60% of them, 49 areas have 0 branches from any of those top 4 banks.
0.
0. Imagine living somewhere like Anjingan in Incheon, or maybe Gochingan in Jeollabuk-do, and suddenly your nearest bank branch is gone.
That's tough. So who fills that gap?
This is where the mutual finance institutions come in. They become absolutely vital.
Like Semal Gimgo and the agricultural co-ops? Nong Yup?
Exactly. They're kind of the unsung heroes here. They're stepping up, often keeping branches open, even when they're losing money on them.
Really? Operating at a loss?
Yeah, in many cases. It's almost like a public service they're providing locally. Semal Gumgo, for instance, has a presence in 82 of those 84 regions the big banks left behind.
So they're the last line of defense, especially for older people who need face-to-face service.
Pretty much. They're crucial for local stability. But there's a catch.
Which is?
Well, if they're operating at a loss to provide this essential service, that puts them under strain too, right?
Yeah, it makes sense.
Absolutely. So you have these mutuals doing this vital public service, but at the same time, they're facing their own financial headwinds, things like rising delinquencies, issues with real estate project financing.
So they're essential, but maybe fragile themselves.
It's a concerning contradiction. Their importance is growing just as their own challenges mount.
That leads us nicely into our final section, the deep dive into corporate strategy. 2 very different approaches to staying afloat or even thriving.
Yeah, first up, K-Bank, digital powerhouse. And they're speeding towards an IPO.
Their growth has been incredible, right?
Just explosive. They hit 15 million customers recently. That's up 5 million in just, what, a year and a half?
Wow.
And their assets ballooned, too, up to around $33 billion. Numbers that definitely grab investors' attention.
But what's behind it? The sources point to the CEO's boss finance strategy.
That seems key.
Yeah.
They didn't just chase everyday customers. They went hard after small business owners, SMEs.
Ah, interesting angle.
Yeah, and that segment doubled in under 2 years. Now it's like 14% of their whole customer base.
And how did they win them over?
By being digitally nimble, basically. They offered the lowest rate collateral loans out there for SMEs, leveraging their platform. They have disbursed over $3 billion in SME loans cumulatively.
So that focused growth, targeting a valuable segment, that's what's fueling the IPO push. Their third attempt, right?
Seems like it. They feel they've improved their corporate constitution, as the source puts it, made themselves stronger, more attractive. Plus, they're making smart partnerships with big platforms like Upbit and Muzinsa, expanding their reach.
Okay, so that's the hyper-growth digital story. Now, the complete opposite, Hyundai Marine's 100-year strategy.
Right. They just hit their 70th anniversary, but instead of big parties, they were busy with some pretty serious internal restructuring.
And this wasn't exactly voluntary, was it?
No, not really. It was triggered by a major accounting change in 2023, the new IFRS 17 standard.
Ah, the accounting rules. Always fun.
Well, this one was a direct hit for Hyundai Marine because they had a lot of older, long-term, potentially high-loss medical insurance policies on their books.
Okay.
IFRS 17 basically forced them to account for the future cost of those policies much more realistically, which meant they had to massively increase their financial reserves, put more money aside.
This sounds painful, like a financial wake-up call.
It definitely was. So much so, they had to suspend their annual dividend payment. First time in 23 years.
Wow. That signals serious pressure.
Huge pressure. But also, you could argue, a commitment to fixing the foundation for the long term. Their turnaround plan was all about substance-oriented management. Meaning stop chasing sales volume, focus only on selling high-profit, high-quality insurance products, quality over quantity.
And did that painful medicine work?
It looks like it. The results are showing up. Their key profitability measure under the new rules, the contractual service margin, or CSM, hit 17.4 times on new contracts in Q2. That's a healthy number.
And their overall financial health?
Improves significantly. Their solvency ratio, the KICS ratio, jumped 13 percentage points from a slightly worrying 157% up to a solid 170%. That's a big confidence boost, especially after having to boost reserves.
And customers seem to be sticking with them too, high retention rates.
Exactly. Their 61st month retention rate was over 54%, beating competitors. It suggests the shift to quality is attracting and keeping the right kind of customer.
So now they're looking at things like AI to manage costs further.
Yeah, managing loss rates, improving efficiency, it's all part of securing the business for the next, 30 years towards that 100-year goal.
So looking back at everything today, it really highlights these core tensions in finance, doesn't it? You've got policy demands clashing with market basics, especially around low credit access.
Definitely. And then the huge split between the super fast digital growth, like K-Bank,
Mm,
and the absolute need for those physical, often loss-making local services from the mutuals.
right. And finally, the kind of radical, sometimes painful internal changes needed just to survive, like we saw with Hyundai Marine adapting to new regulations.
It's a really fragmented picture. We're speeding towards digital convenience in some ways, but simultaneously seeing basic local access just crumble in others.
Which brings us to the final thought for you, our listener. Seeing how reliant communities are becoming on these local mutual institutions as the big banks pull out, you have to wonder, what's the real, maybe hidden cost of all this efficiency and digital transformation in finance? And maybe more directly for you, how can you make sure you have reliable, accessible financial services for yourself, for your community, when the whole landscape seems to be polarizing so quickly between the digital haves and the physical have-nots? Something to think about as you manage your own finances.